Welcome to the SNN Network Canada virtual event. I'm your host, Robert Kraft, and thank you all for joining us today. I'd like to introduce our next panel. This panel is titled Accessing North American Markets in the Current Regulatory Environment. And we're pleased to have Laura Anthony, founding partner at Anthony LG PLLC, to moderate today's panel. And with that, Laura, take it away.
Thank you, Bob. It's a real pleasure to be here today. As Bob mentioned, I'm the founding partner of Anthony LG PLLC. I've been practicing corporate and securities laws since 1993 and founded the firm in 2001. Can't believe it's been 20 years. So it's been a minute. And I've seen a lot of changes in those times, and we're going to be discussing some of those changes today with my fellow panel members. I have Peter Goldstein, Chad Friend, and Chris King, and I'm going to allow each of them to give a little introduction to themselves. Why don't you start, Peter?
Great, Laura, thank you. Pleasure to be here with everybody. I'm the founder and CEO of Exchange Listing. Exchange Listing is an advisory firm that works with issuers that are either public companies looking to go to a higher level of an exchange, or private companies that are looking to go public for the first time and listing on either the OTC or other exchanges, more with a pathway towards a senior listing on an international exchange.
Hey, good morning and Happy New Year, everybody. My name is Chad Friend. I'm an attorney at Anthony LG PLLC, and I spent 8 years practicing with a primary focus on representing public companies and investors in the OTC and the exchange spaces.
Thanks. And Chris, your turn.
Hello, everyone. Yep, I'm Chris King with OTC Markets. I've been working in the financial markets for more than 20 years now, but been with OTC for the last 7. My role here at OTC is to help companies to go public within the US.
Great. So, as I mentioned, I've been practicing for quite some time. And during that time, I've seen the securities laws and the regulations affecting small and micro-cap companies go through dramatic changes, right from the top, where you actually have the regulations and the SEC rules and regulations and FINRA rules and regulations, down to the bottom of the policies of the brokerage and clearing firms that they do business with. And there's been such changes in all levels, especially in recent years. I saw for a time it was really difficult for an OTC markets company to gain respect in the marketplace, and just went through a period of what I'd call a bad rap. But I've seen some really great improvements and changes. Chris, you're going to talk about those as well over the past years. Even the past year, there's been such a positive shift. And I really see that OTC Markets is and will continue to be a globally respected venture market. And part of that shift has been a complete overhaul in the Rule 15C to 11 process. Now, a lot of people have probably heard about this overhaul. It hasn't taken effect yet, so we're gearing up, but it's going to make a real change in the way companies are quoted, can be initially quoted, and continue to be quoted on the OTC market system. I'm going to give a brief, really high level of the rule change, and we're going to really delve into it with the panel members. But from a very high level, the new rules will allow an interdealer quotation system, which is an IDQS, and in reality, that really is OTC Markets itself, to complete a 211 compliance review for the initial quotation or resumption of a quotation of a security, and for the availability of an exception. And a broker-dealer will be able to rely on that review instead of having to do their own review each time. This is a huge change from the current system. It will also require that all companies have current information, which is specified in the rule, what their timetable is for each category of company and how they can maintain that current information in order for its securities to be quoted. So we will no longer have securities with no information, dark securities quoted in perpetuity, said that word right, hopefully, on the OTC markets. And then it also creates a few new exceptions, including for low risk securities, such as those with a high value of trading volume, at least 50 million in total assets, and at least 10 million in stockholder equity. It also has limitations on the availability of exceptions for insiders and affiliates unless a company has current information. I believe the rule changes are necessary, they're positive, they're really going to improve the quality of companies that are trading on OTC markets. We'll see a big shift towards the OTC QB and QX, and ultimately a shift in companies that make it to uplisting to the national securities exchanges, and just a great improvement in our public company system. But Chris, why don't we start, because I've said a lot, big mouthful about this 211, but why don't we back up and maybe Chris, you could tell us a brief summary of the OTC Markets Group itself, including like its main business components, its corporate services and market data and trading services, and just start from the top. Sure.
Thank you, Laura. So for those of you that aren't too familiar, OTC Markets Group operates an ATS, or an alternative trading system, also referred to as an IDQS, as Laura mentioned, an interdealer quotation system. The platform that we operate, like any other stock market, provides a variety of services. The three main businesses that we provide are, from a corporate services perspective, which is the department that I work in, which is where we engage directly with issuers or companies that want to be publicly quoted or traded within the US. Our market data services obviously provide essential market data to brokers and users. And then our trading services team provide essential trading functions for the active brokers on our marketplace. So just like the US exchanges, we provide the same facilities in terms of trading. And we're providing a conduit or a platform that US brokers can then provide liquidity and execution services. So to simplify it, think of it like a stock exchange. It's a stock market with over 11,000 securities quoted every single day. The market cap of those companies on our marketplace is over 18 trillion US market cap, and hundreds of billions of dollars of volume is traded across our markets every single day. So for the sake of this discussion, specifically with Canadian companies, for example, we enable Canadian listed companies to be publicly traded in the US at a fraction of the cost of a US exchange listing.
So I was going to have you next talk about the three tiers, but why don't we jump in real quick? And since you brought up the Canadian listing, why don't you give us a brief summary of how does a Canadian company trade and become trading on OTC markets?
Sure. So there's two paths to the market, if you like. So if you are already public on an exchange, so for the sake of this discussion again, if you're public in Canada, but the US is important to you, you are able to allow US investors to trade your stock freely through the brokerage account of their choice. So think about US investors, they invest in US dollars, and no matter where you're listed globally, they trade in US market hours. And so from an investor's perspective, they don't necessarily care about the plumbing per se, but when they put your company name into their US brokerage account, of course, they want to be able to have a market being made. They need a bid and an ask, and they need liquidity. And so that's a function that's provided through our business. But the two paths to market are simply that if you are public in Canada, and so you're already public, you're already transparent, you're shareholder friendly, and you're complying with all of your home market regulatory requirements, you are able to be quoted within the US by US brokers, thereby facilitating US trading flow by way of an exemption. And so part of what we'll talk about today is that exemption, and ultimately how you can maintain a continuous quote in the US. And so if you're on a US exchange, whether it's the CSE, the Venture, the NEO, for example, it's the same exemption that you can potentially qualify for that enables hundreds of companies to be publicly traded within the state. So it's the ordinary share that's already public in Canada, and it's our business that enables the access point to those shares. So for the investor, it's seamless trading. For the company themselves, they love the fact that it's a unique model. It's an SEC exemption that they benefit from. And so they continue to disclose in the same format that they do today through CEDAR. but they're able to grow their US ownership and make their information available, make their shares available, and just grow. It really just supports the model of accessing US at a lower cost and complexity. The second path to market would be if you're currently private and looking to go public, and perhaps you choose the US as your primary market. Then you have decisions to make in terms of what market to trade on, how to go public. It would depend very much on whether you're raising money and other criteria. But our QX market is the top market tier. And so companies that join that, if they're not publicly traded on a foreign exchange, obviously there has to be a disclosure mechanism. So the SEC filing is used by companies who go public within the US on our market, whether it's QX or QB, the venture market, or the pink market that we'll touch a little bit more on. So they're really the two paths to market. You can piggyback off of a foreign exchange, or you can use, you can go primary listed, so to speak, in the US.
So our firm does a lot of sponsorships for companies that are traded on foreign exchanges, including out of Canada, and help them through the process. And I'm always talking to these clients about the three tiers of market. As you mentioned, your QX is your highest, and your QB is your middle, and your OTC Pink doesn't really have a lot of requirements other than to basically have a profile page and an active 211, right? But these companies, some companies will choose for some reason or another to go to the OTC Pink, although I encourage them not to. The new 211 rules will eliminate the ability of a company to simply go on OTC Pink and rely on their filings in another country in order to meet those requirements. And I do want to give other people a chance to talk, but Chris, just one more quick one for you. Tell me why these companies will no longer be able to just go onto the OTC Pink and rely on their filings in Canada through CDAR in order to satisfy the new 211 requirements?
Well, we've been working for many years to improve the trading experience for brokers, for investors, for companies over the years on our market. And so, when we talk about our QX market, some of our largest clients include Roche, Heineken, Adidas, BNP Paribas, just to name a few. And so for those companies, they understand that the tiers of the market are important. Very often the investors don't necessarily understand the plumbing and how trades are executed and where they're settled and that kind of thing. But the tiers of the market are important and have been for years. And so to answer your question, the higher the tier of the market that a company trades on OTC, the overall, the better experience. So better compliance, better engagement from the issuer, better information flow for news and financials, and tighter spreads, and just a better trading environment. So the reason why I thought I'd give you the context there is that we've been telling companies for years that, QX, what you're really paying for is better compliance, better information flow, and a better experience for the investor. And the result is more US ownership, better liquidity, and a premium to valuations, lower cost of capital. So as you work your way down to the QB market, the venture market, naturally you'll find much smaller companies, but they have the same desire and they want the same outcome as those larger companies on QX. So to answer your question with Pink, it's really an open environment that broker dealers can set up a ticker symbol. Historically, companies have been able to rely on this piggyback eligibility, meaning that because a ticker was set up without the engagement from an issuer, the company is not posting materials to the system, the information flow is somewhat limited. The answer to your question is that really the major change here that we see with this reform that actually went into effect last month, but there is a grace period for companies to comply. So we do have some time. But later this year, what companies are going to find is that due to the lack of disclosure on our market, on the lower market tiers, those companies are going to be impacted because they're not providing sufficient information and news flow that brokers that would then be able to rely on. And so they're the companies that are going to be impacted by this reform. So the piggyback eligibility simply means that historically brokers could clear a 211, the ticker symbol set up, and a company benefits from continuous quotation. With the removal of that piggyback eligibility, it simply means that there will be many companies, and for the sake of this conversation, let's use Canada as the example. Those companies have a decision to make. If they care about the US markets and they want to ensure that investors continue to benefit from access to the shares as freely as possible, we would always recommend, the QB or the QX markets, because those companies are posting material news. They are required by our rules to be engaged with brokers in the market, and by the function of being on our system, they're posting information. So they would naturally be meeting the information requirement based on this reform. Pink companies typically are disengaged, and so that's really the key point here.
Great. So, Chad, I mentioned, has a history, or he mentioned a history representing investors, and that's generally a more professional investor. But, they know and have known for a while the importance of having current information and information about a company. I see a lot of companies that come to me and they say, we just want to go public on the pink, and they think they're going to be able to access investor funds from the capital markets and raise capital. And it really is not that easy. It doesn't work that way. There are things that investors have already looked for and that companies need to be educated about so that they can attract investors and get the most out of the capital markets, especially a Canadian company coming over if they want to access US capital markets. So Chad, why don't you talk about what some of the things that investors look for in a company? It really plays into the 211 rules, because if they, they're going to need to require to comply with those. But why don't you talk about what professional investors and non-professional investors should be looking for in companies, and how companies can make themselves attractive to investor communities and get the most out of being public?
Absolutely. So I think for the Canadian traded companies, I think that the biggest point to look at is whether they are filing as an alternative filer here in the US, or going the whole way and becoming a fully reporting Exchange Act company. And so that's really the primary and number one thing when examining those types of companies. And so what's important here now with these changes is that there was a runway of, in some cases, many cases, several years of when a company went delinquent, stopped filing, where it would still trade. And so you would have years of trading, and they may be asleep at the wheel on the company side. And so you didn't have the information. So now they're forcing that issue to come to fruition much sooner, and pulling the 211 under these new rules. And so I think that from an investor standpoint, they will be looking at a company's history, their filing history. Have they had periods of delinquency in the past? Looking at, I think the position of CFO will become a lot more important in terms of what the experience is of the company's CFO, to see whether or not that continuing the filings and staying current with their information, especially from a financial standpoint, is feasible, as well as cash on hand in order to afford all the expenses of continuing to be public. So, in this new environment, there will be no runway of several years. It'll be a very quick period where if the company goes delinquent, they will no longer be quoted. And so I think that becomes very important, and as well as OTC Markets' role in this process. And historically, if a company is no longer quoted, it's very difficult for that company to go through the process again, have a broker dealer who's willing to tag along for that ride and go through the process with FINRA and the due diligence deep dive review again in order to try and be quoted and have the ticker. So in this new era, with some of that, or maybe even a majority of that burden shifting to OTC Markets, it will be interesting to see how difficult that process is for companies that are down on their luck, maybe due to COVID-related market issues in their business, or just due to a lack of cash flow. They were unable to stay current in their filings, subsequently have an ability to do that, come back to the table and catch up on those missed filings. It will be interesting to see the process with OTC Markets and how difficult or maybe easier than it is today to get back on path to publicly trading and being current.
Does it matter to investors whether a company trades on the pink, or do they really want to see them on the QB or QX? They want to see that higher level.
Yeah, I think it absolutely matters. And, a big here in the new era, I think that in general, people believe that OTC pink companies may be more fly by night. They may not be current in 6 months or a year or 2 years. There's a much higher risk, a perceived risk, I think, with OTC pink companies that they may not be around in the future. So absolutely, I think that a QB designation and ultimately QX is very important, and even more so now. And we can get into this later, but the new rules here on the 211 side, coupled with the proposal on the new changes to 144, these two items together is going to place a strong significance on which tier a company is currently on.
Right. And I just want to add in that regard that a lot of times a Canadian company comes and it does rely on an exemption, Rule 12G 3-2B, to not report on the U.S. side. But from an investor standpoint, that company is a non-reporting company, meaning that the Rule 144 holding period is 1 year and not 6 months. So, I think that that's something Canadian companies should consider when they're dual quoting, especially a company based out of the U.S. that goes public in Canada in the first instance for one reason or not, but really wants to attract U.S. investors and wants to make the most out of the U.S. markets. I think it's important for them to report to the U.S. I wanted to add that. But Peter, I know that exchange listing, your company can provide companies with assistance and compliance with these new 211 rules. Want to tell us a little bit about that?
Thanks, Laura. Absolutely. I think just to follow up on Chad's comments, I think ultimately for the investors, increased governance, increased transparency will benefit both, the investor community as well as the issuer community. We work predominantly with the issuers in conjunction, Laura, with you and your firm and legal services, and Chris and the OTC Markets.
Right.
We work more on a hands-on role with the issuers and all of the other aspects that come along with needing to maintain their corporate governance and their compliance, not just the 211 rules, but also to increase their positioning. We look at an uplisting, whether they're going from the pinks to the QB or the QB to the QX, all requiring additional issuer actions. And that could be a combination of restructuring, could be including corporate governance, added disclosure, added financial reporting, in addition to all the legal services that you would provide. We look at it that we kind of quarterback that process. The issuers, typically are focused on running their day-to-day business and need someone else who can understand the challenges that they would have in maintaining these different levels within the markets. Ultimately, for us, our goal is to bring companies onto a senior exchange. So for Canadian issuers, as an example, we just are working with a group that we took from the TSX to a US listing into NASDAQ. And they were able to raise $12.5 million in an IPO, and then within 90 days raise another $13 million, where they didn't have access to that type of increased liquidity and capital that was available in the Canadian markets. And maintain a dual listing, whether that's on the OTC, QX, or on other areas that can benefit the company. It's a lot of strategy that goes in now. As Chris mentioned earlier, there's a 9-month, kind of ticking clock here. And issuers need to really look at, how are they going to satisfy the short-term requirements of this new reform with the 211, but we like to look at it also with midterm and long-term. So our services are much more strategic. They're much more working with the issuers and developing a pathway and a capital market roadmap. Ultimately, the goal here is to provide additional capital, transparency, corporate governance, so that the companies can continue to grow, develop themselves as a public company.
Right. And, that's a great segue for something I was just thinking about. And that is, in addition to, of course, I think helping to eliminate, or maybe not completely eliminate, but to reduce microcap fraud, which is a real issue that hurts the reputation of small companies. a few bad actors always ruin it for the rest of them. I think that the rule changes are going to make a huge impact on microcap fraud. But in addition to that, along with that, there is going to necessarily be a higher quality of company that goes public, and a company that's serious about making the most out of its public markets. And with that comes the need for additional corporate governance. So companies like yours will really have more of a place where people are going to have to pay attention to that corporate governance. They're not going to be a one-man board of directors that takes this company public with zero revenues and a hope of some sort of, uptick through, easy money, because that's not what's going to happen. And along with that additional need for corporate governance and a more serious company, there's going to be a fiduciary obligation on management. And I think we have us service providers and OTC Markets itself as well will need to spend time educating these companies on their fiduciary obligations to their shareholders, and that you can't just be a free ride pink company with no information any longer, because your shareholders will not be able to get what they need out of being public, and you're going to have real director liability, because you're going to have companies that have real assets, and there'll be a real concern in that regard. And I think, again, QB or QX, where they have higher corporate governance and reporting standards, helps protect that fiduciary obligation for management, so you see real difference there.
Completely agreed. Yeah, Laura, sorry,
yeah,
I didn't mean to interrupt. There's a slight delay, but I want to just add in that often the corporate governance and the financial reporting has been an afterthought. Where now with this new reform, it has to be put on the forefront. I think for those investors that are listening, they do have now to look at the management, and that management does have a fiduciary responsibility to maintain, full reporting and transparency and corporate governance, which will ultimately benefit the investor, but in the long run, it'll benefit the issuer. There just has to be a focus now on making that a forefront, because if not, then they really won't be a true public company when this reform kicks in, if they're on the OTC. So it's a very meaningful issue from both, the fiduciary responsibility, as well as the investors who are looking at the companies they've invested in and asking management what management is doing to satisfy the new requirements.
Yeah, and I see it being a real push and creating momentum, right? So the more that you're going to have companies that are going to take their corporate governance more seriously, you're going to have companies that are going to move to the QB and the QX. You're going to have fewer companies that are, really shouldn't be public yet, right? You're going to have fewer of that. They're going to go by the wayside. And then you'll see more companies continue to uplist. So QB, they'll uplist to the QX, and ultimately they'll uplist to an exchange, which is great for everybody, right? OTC Markets is really the venture marketplace. As companies uplist, investors will gain more confidence in companies that are on the OTC market. So it will help them attract a better quality investor. I think clearing firms will, brokerage firms and clearing firms will look at them differently, and hopefully their regulators and FINRA and their audit process will see things differently, and it'll allow for, there's been a lot of issues with people being able to deposit stock, and companies like Merrill Lynch or Bank of America that owns Merrill Lynch saying that they won't trade in certain stocks. I think that it'll be this whole momentum that will gain respect all across the board. And we'll see that more of the bigger players are going to open their doors and allow their people, like brokerage firms and clearing firms, to trade these smaller company stocks, and more investors will be willing to invest in them. But I'm going to jump now completely. But I'll go back to you, Chris, for a second, because one of the things that we've been talking about is Canadian companies. Now, Canadian companies can trade ordinary shares. In fact, a lot of companies can trade ordinary shares, but what about an ADR? How will the new rules and how will OTC Markets be impacted with the use of ADRs coming forward?
Yeah, thank you. And apologies, I was having some trouble with my internet connection, so apologies for not engaging in the earlier discussion. So ADRs are going to be equally impacted as with any other company being public within the US on OTC. And again, it doesn't really matter whether it's QX, QB, or Pink. The requirement here is of a disclosure nature. And so QB and QX will meet the standard. So for companies who have an ADR, so for OTC markets, that's all level 1 ADRs are traded on our market. Those companies will need to meet the standard as they would whether they had an ordinary share or an ADR. There's likely to be some exemptions, and so we're certainly looking to navigate that and accommodate as many companies as possible. The exemption will likely take the form of a market cap requirement, or perhaps inclusion in a certain indices. And so again, this discussion was primarily around perhaps smaller cap companies and looking to work their way into the US financial markets. It doesn't really matter whether it's an ADR or an ordinary share that's available currently. Those companies would need to meet the disclosure requirement. So we are working on a solution for disclosure. So in the same way that a QB or a QX company with a level 1 ADR meets the standard, if they're on pink, they will have options as to how to meet the new disclosure requirement. But doing nothing as a small or perhaps even a mid-cap company is going to be costly in terms of US access.
Right. So Chad, again, go back to you with investors. An OTCQX, in order to qualify for the OTCQX, you have to be penny stock exempt. You can't be a penny stock. How important is it to investors that a company not be a penny stock? I mean, most exchange traded companies meet an exemption from the penny stock requirements, though some of them fall into that category. But how important is it to an investor that a company be exempt from the penny stock requirements or not be a penny stock, and explain some of that?
Right, and one quick point on the prior discussion too. I think that there will be a lot more of a process prior to going public by companies who are maybe conducting pre-public investment rounds to have more of a cash on hand prior to getting deep into the process, right? So they will want to make sure that they have the budget to handle all the obligations going forward, since it would not make sense to start the process, go public, have the 211 in place, and then lose it several months or within 12 months of that process starting, right? So I think that it will, as you had mentioned, it will dissuade some of those companies who may not have any business being public at that stage in their life from going that route, and instead waiting until they're ready. There will probably be more of a focus on, or at least more transactions that occur in the pre-public stage from an investment standpoint, so the company is poised to take the leap. But going back to your question, I think that in today's market, it becomes very important, the penny stock versus penny stock exempt designation. When you're looking at both the 211 rules as well as the new proposal to the changes to Rule 144, it becomes very important. I think that companies that are not penny stock exempt are more likely to become delinquent or behind on their OTC filings or their SEC filings, and so the risk is much higher. At least I think there is a perceived risk for companies that are not exempt. Although there are a lot of companies that are still viable and climbing the ladder and that haven't reached the exempt status yet. But I think this will prompt more due diligence on those companies that are not yet there, and that are either on the OTC Pink or QB. It will prompt a lot more due diligence on the investor side and on the broker dealer side that are engaging in equity raises or debt raises and other corporate finance transactions. It will prompt more due diligence on their end to see whether or not the penny stock or OTC Pink or not fully reporting company will be able to maintain their obligations and maintain a quotation.
Thanks. I touched briefly, I mentioned, a U.S. company going public in Canada. It's interesting. We've seen a really big uptick in the past few years of companies that dual list or that go public, even based in the US, in Canada, and then dual list over here. And part of that has been like a lot of cannabis companies, because it was, they can't list on a national exchange here in the US while it's federally illegal. So, and it's federally legal in Canada. So a lot of companies in the cannabis space went public in the US, in Canada, and then dual listed back over here. Historically, we saw that with mining companies, because mining is just a hotter thing in Canada. There was more capital available. We're seeing that now with the psychedelic marketplace. There's a lot of pharma companies that are doing experimentation into microdosing of psychedelics for pharmaceutical purposes. We're seeing it in that arena. But, it can go the other way. A company could go public in the US and then dual list in Canada. But there's some benefits to dual listing. And Peter, why don't you tell us a little bit about capital raising through a dual list, and what companies how they can take advantage of this process?
Most of these smaller, earlier stage growth public companies need access to capital. They've gone public predominantly to have access to capital and to create liquidity for their investors. So we've seen it work both ways. Laura, we recently took an OTC QB company, uplisted them to the OTC QX. Immediately, they were able to raise more capital by us simply putting in additional levels of corporate governance. And so we brought in the audit committee, we raised their corporate governance, and that immediately gave them access to more capital. And that's a US-based company, US domiciled entity, but where the next step is to actually take them to Canada, to the NEO exchange, where exchange listing is a trusted service provider at the NEO, which is not a paid designation, it's something that's earned. And we see the NEO as a great opportunity for US-based companies who want to maintain trading in the OTC markets, but to have access to capital, perhaps before they go to NASDAQ or the NYSE, as an intermediary step. And it depends on the sector, of course, as you mentioned. Certainly there are hot spaces right now in Canada that US companies may be able to access Canadian capital, and the other way around, where we've been able to take Canadian companies to the US markets to access US capital. So the cross-border strategies work both ways. And ultimately, for a company to be able to access that capital, they need to really fill upon their business plan. And whether that strategy is to maintain a US and a Canadian, or vice versa, with one being primary and one being secondary, without the ability for growth companies to access capital as a public company, they're not going to be able to see the increase in their market cap, the ability to implement the strategies that they have for their growth. So capital raising is critical, and the higher tier, along with the reforms here, and of course, I think the 144 changes are going to impact greatly both pros and cons about how to access capital. So we take a step backwards with a company and look at a capital market roadmap, ultimately to find out where is the best opportunity from a cross-border perspective. So it's fairly fluid for us, whether that's Canadian companies looking to access the US markets or vice versa. There are different pockets of institutional and monies that are interested in certain sectors and certain areas of whether they're trading both Canadian hits, the Canadian investors, and US vice versa. So we see it as a very fluid, unique time where the capital markets are wide open right now. And of course, the cross-border work requires a lot of specialty, where you have the US security side as well as the Canadian security side, and then integrating all those into one.
Yeah, we work a lot with some great Canadian law firms on these cross-border companies, and we work hand in hand. And like you said, it requires a lot of work on both sides. We've talked. Chad mentioned the new Rule 144 rule change, and you've mentioned it, but I haven't described what it is. So let's delve in. Here's another rule change that's going to directly impact companies on OTC markets. And again, I think it's although I have a lot of questions on the rule change, and Chad and I were talking earlier, we're going to write a comment letter to the SEC. We have a lot of thoughts and questions on the way it's proposed. I think, again, it's a positive step for OTC markets. Anything that shows a higher level of regulation and compliance and corporate governance for OTC markets companies is only going to help everybody. But the rule change, for those listening, is the SEC has proposed to eliminate tacking of a holding period under Rule 144 for market adjustable convertible securities for OTC markets companies, or I should say non-exchange traded companies. So if they don't trade on a national securities exchange, then they will no longer be able to tack under the original holding period. So what that means is, say a company, if it's market adjustable, so let's say a company has a convertible note, which is a very common structure for investments in both exchange traded and OTC markets companies, but a company will invest via a convertible note. And after a 6-month holding period, it can convert into regular common stock that trades, tack onto its original holding period, or 1 year for non-reporting companies, and immediately resell that underlying security. And a lot of times those convertible notes are, or it could be convertible preferred stock, they are exchanged at a discount to market, right? So if you have a 20% discount to market, and you exchange and you're able to immediately resell, you do immediately resell, well, you really have a 20% built-in profit. And what the SEC has proposed to do is eliminate that tacking period. So if it's market adjustable, i.e. it changes at a discount to market, then it's you're going to have to start a whole new holding period when you exchange. And maybe Chad, what do you think? You're in the investor side of the world talking to investors. What is it's just a real proposal, but what are their thoughts on that? And where do you see investment structures going forward for non-exchange traded companies if the rule is implemented?
Well, I see a lot of the larger investors migrating, honestly, to the exchanges. But on the OTC space, I believe that we will see a lot more activity from the broker dealers that have more of a focus in the micro and small cap spaces, taking a dive into equity raises for OTC companies. Since if the change goes into effect in its current format, I think we will see much more of that, since there will not be as much debt overhang.
A positive for everybody.
Yeah, but I do think that there is a huge value to these companies being able to raise funds through the issuance of debt when they're in situations where an equity raise is not immediately feasible. And so there will be a period of navigation and settling if the rule goes into effect as currently proposed, where the footing has to be found on what the new normal will look like. But I do think, yeah.
Do you see an increase in fixed price conversions, number one, and in registered deals, number two?
Absolutely. So I do think there will be variable deals that are registered, and I do think we will see a lot more of non-registered fixed price deals with some type of anti-dilution protection if they're on down rounds, and so I think we will see there is a bit of an evolution period after the rules go into effect, and what that final rule looks like is going to dictate the direction it goes. But I think it will have a significant impact, and specifically, going back to the tiers, I think that from a fixed price standpoint, the investors are going to place a strong significance upon what tier the company is in, and are much more likely to do a fixed price transaction with an OTCQX company than an OTC Pink company. So we will see that unfold here over the next few months.
Right. I want to point out, that's a good point that you bring that up, is that some investors and even some OTC Pink companies don't realize that although the SEC allows an at-the-market offering for the resale of securities, right? So unless you're S3 eligible, you can never do at the market for a primary or indirect primary offering. It does allow it for the resale. However, it never allows an at the market resale offering or registration statement for an OTC Pink company. You have to be on the QB or higher. That's in all circumstances, not just for an equity line of credit, but for any resale. So, that's important for investors to know that. It's important for the companies that are on the OTC markets to know that they need to be on the QB or the QX to really access investor capital and get the most out of being public. And ultimately, I think important for an uplisting. I know we're getting close to running out of time, so I'm just going to open it up to each of you to say whatever you'd like to say, as maybe 2-3 minutes each for closing. So this wonderful panel and have one more chance to say your piece. So Peter, why don't you start?
Great. First, I want to thank everybody. It's been a great panel, and I think ultimately this is really going to benefit both issuers and investors. The changes here, if you take the common theme, are driving towards more corporate governance, more transparency, and ultimately an increase in liquidity and access to capital, which are all the benefits that a public company wants, as well as the investors. So from the exchange listing side, we're thrilled to work with companies that want assistance in quarterbacking the process, on being able to look at strategy and understanding the different options that exist, both in satisfying the new requirements in the 211, as well as uplisting, and really ultimately in pursuing the growth that they want and the vision that they have for their company. So thank you for the opportunity to chat with you all today.
Thank you, Peter. And Chad, you're up.
Absolutely. So I think in this new era, we'll have to see where everything goes and how it settles in after the changes go into effect. But what I'm most interested in seeing is how OTC markets, what type of role they take in the process, and how difficult or how, if it becomes easier for companies to have quotation after losing it, being able to go through the process and getting back on track. There are many scenarios where a company in the micro and small cap space may go through a tough period, and they may not be able to meet those obligations and staying current in their filings. But they have an opportunity later on in the subsequent months to get back on track. So it'll be very interesting to see how OTC Markets addresses that, and what the process. Hopefully, it'll be more of a streamlined process for those companies that are able to get back in order.
Right, and Chris, are you back in here? Oh, there you are, just on time for your closing. Go ahead, Chris.
Yeah, better late than never. Apologies for not being able to contribute too much today. So yeah, I just think in summary, the rule changes have been incredibly positive. It certainly gives OTC markets a tremendous opportunity to streamline the onboarding process and to assist companies as they go public in the States. And anyone that wants to receive more information is welcome to call me. My email address is cking, C-K-I-N-G, @otcmarkets.com, and my telephone number is 347-383-5521. I welcome any queries or questions.
Thanks, Chris. And we work together quite a bit. It's a real pleasure. But thank you, everybody, for coming into this panel. Feel free to call any of us. We'll have our information. I'm L. Anthony at AnthonyPLLC.com, and but all of our information is up on the SNN website for this panel and for the conference. And feel free to reach out to any of us at any time. We're happy to help and answer any questions that you guys may have. And thanks for listening, everybody.
Thanks,
Laura.
Thanks, everyone. Happy New Year.
Happy New Year, guys.
Happy New Year.